Today, we are cracking open an absolute classic, Peter Lynch's One Up on Wall Street. We're going to break down his incredible philosophy that basically says you, the average person, actually have a secret weapon against the Wall Street giants. And that weapon? It's the knowledge you already have from your everyday life. So let's dive in and see how this works.
Lynch kicks things off with this powerful idea. So many of us look at the pros, the big institutions, and just feel small, right? It's like we're a local Little League team going up against the pros. We feel totally outmatched. But what if Lynch is right? What if that whole feeling is just wrong? And this is where he just flips the whole script. He argues that the Wall Street pros on the left, they're actually the ones at a disadvantage. They're tied up in rules, they have to worry about what their boss thinks, they have to follow the herd. But you, the amateur investor on the right, you're free, you're independent, you're nimble. That's not a weakness, that is your single greatest advantage.
Okay, so how do you actually use that freedom to your advantage? Well, that brings us to the very first pillar of Lynch's entire philosophy, really understanding your built-in edge over the professionals. It all comes down to this one key concept he called street lag. Think about it. Wall Street is slow. By the time some analyst sees a great company, writes a report, gets it approved by 10 different committees, the stock might have already skyrocketed. But you see things happening right now, in the real world, at your job, at the mall, in your own neighborhood, way before it ever shows up on some fancy Wall Street report.
And this is where your power really kicks in. You're the one who noticed that everyone was suddenly buying legs pantyhose at the grocery store. You can invest in that small, awesome company that the big funds literally aren't allowed to buy because it's not big enough for them. And here's the best part. You don't need to be right 100 times. You just need a few huge winners, what he famously called Tenbaggers, to make a massive difference.
So, you've used your edge. You've spotted a company that looks promising. What's next? Well, Lynch says you absolutely have to know the company's story. It's not just about what they sell, it's about what kind of investment you're making. And he made it super simple by breaking everything down into 6 main categories.
And here they are. This is like your cheat sheet. You've got your slow growers, which are usually big, dividend-paying companies. You've got the giant, reliable stalwarts, the super exciting fast growers. That's where the real home runs are. Then there are tricky cyclicals, the high-risk turnarounds, and the hidden value asset plays. Knowing which bucket your stock fits in is everything, because it tells you why you're buying it, and maybe more importantly, when it's time to sell.
Now, you could tell Lynch really loved the fast growers. These are the smaller, hungry companies that are just expanding like crazy. This is where you find the stocks that can go up 10, 20, even 40 times your initial investment. And they don't have to be in some flashy tech industry. Think of a company in a boring industry that's just relentlessly taking market share from its competitors. That can be a fast grower too.
Then you've got the cyclicals. You have to be so careful with these. They're probably the most misunderstood stocks out there. We're talking about airlines, car companies, steel companies. When the economy's booming, they do great. When there's a recession, they get absolutely crushed. If you buy them at the wrong time in the cycle, you can lose almost everything. But hey, if you actually work in the auto industry, you have a huge leg up because you can see the cycle turning before anyone on Wall Street can.
Okay, next up is one of my absolute favorite parts of Lynch's work. It's so counterintuitive, but it's pure genius. It's all about how to find those amazing companies that literally no one else is even looking at. So what does the perfect stock actually look like?
You're gonna love this. According to Lynch, the perfect stock is boring. It's got a boring or even silly name. It does something kind of dull or maybe even a little gross, like hauling away toxic waste. And the big Wall Street firms, they don't own it. Why is this so great? Because nobody pays attention to boring companies. It gives you plenty of time to research it and buy it at a great price before the thundering herd finally notices how much money it's making. And the ultimate tell? If the people who run the company are buying their own stock, that's a fantastic sign.
And on the flip side, here's what you should run away from. Fast. The hottest stock in the hottest industry? No way. That's a recipe for disaster. Be super skeptical of any company that people are calling the next Microsoft or the next Amazon. The next something almost never is. And definitely avoid those whisper stocks. You know, the ones with an amazing, world-changing story, but zero sales or earnings to back it up. That's not investing, that's just gambling.
You know, this leads us right into the mental traps that we all fall for as investors. Lynch came up with this brilliant list of the silliest and most dangerous things we tell ourselves. Let's bust a couple of the biggest myths right now.
Oh man, myth number 1. We've all been there, right?
You're watching a stock just plummet, and you think to yourself, well, it's got to stop falling sometime. It can't possibly go any lower.
And Lynch's response is just so direct and perfect. Of course it can go lower. A stock that's down 90% can still fall another 90%. The price tag itself doesn't mean anything. You have to look at the business. Are things getting better or worse for the company? That's the only question that matters.
And here's another one we love to tell ourselves, especially when we're losing money. It's this idea that just because things look absolutely terrible for a company, a turnaround must be right around the corner.
The comeback to this is just fantastic. Sometimes it's darkest right before it goes completely pitch black. The point is, you don't buy a stock just because it's getting hammered. You buy it because you've done the research and you see actual proof that the business is getting better. Remember, hope is not an investment strategy.
So after you've done all this work, you've found a company, you've put it in a category, you've checked for all the red flags, Lynch gives us one last brilliant test you have to pass before you invest a single penny. It's called the 2-minute drill. And here it is. This is the final boss. Before you buy, can you give a 2-minute speech explaining exactly why you are putting your hard-earned money into this company?
And we're not talking about some vague, fuzzy feeling. It needs to be a structured pitch. Step 1, what does this company actually do to make money? Step 2, what's the story here? Why is this going to be a big success? And step 3, what are the key facts and numbers? The sales, the profits, the debt that prove your story is actually based in reality.
The real beauty of this drill is that it forces you to be clear and simple. Lynch's rule of thumb was, if you can't explain why you own a stock to an interested kid and have them get it, then you probably don't understand it well enough yourself. And if you don't really understand it, you have no business owning it. Period.
And that really brings us home to the single most important quote from Peter Lynch, the one that sums up his entire philosophy. It all boils down to this. Investing isn't some secret code. It's about using the knowledge you already have, doing your homework, and being able to tell a clear, simple story that you actually understand. Know what you own and know why you own it.